Welcome, everybody. It's Matt Kramer here at the Foundation. Thank you for joining us today. It's great to see everybody. We have with us former trustees, we have current trustees, we have donors, we have advisory council members, we have parishes and schools that have funds at the Foundation, and all of us have the same common concerns and questions about how we're doing on our investments and with our strategies and policies going forward. So I want to introduce you to Taylor Covey and to Brian Falco from LCG Associates out of Atlanta. LCG has been the investment advisors to the Catholic Foundation since 1994. We're very pleased with their services, and this is just an opportunity to have an update from them on the markets, what's happening, and what their crystal ball tells us. So Taylor and Brian, I'm going to leave it off to you, and if the rest of you just could mute yourselves, we'd appreciate it. Thank you.
Sure. Thanks, Matt. I am going to try and share my screen. Can you see that?
Yes, we can.
Perfect. Okay, I'm going to start off, and then Taylor will take over. First off, thanks for having us. It's good to see everybody, a lot of familiar faces, so that's good. And I'm going to take a really quick minute just to go over LCG, kind of who we are. I know a lot of you already know, so I won't belabor the point. And I'm glad Matt said that 1994 was the start date, because I didn't remember. I joined the firm in '96, and I knew that the Catholic Foundation was a client already, so I knew it was before that. But just a quick overview, the firm's been around since '73. We're an independent firm. Taylor's in our Atlanta office, which is the headquarters and where the majority of the employees are. I'm in Dallas. We're employee owned. Taylor and I are two of the significant owners of the firm. We work with 100 clients, about $100 billion in assets. So pretty straightforward. We kind of see ourselves as a firm of analysts. What I mean by that is Taylor and I, although client facing, are also responsible for the analysis that gets done on both a manager level and asset allocation level for the firm and for the clients. We kind of do it as a group, and we customize our advice to each client. So no two clients we have the same portfolios, because no two clients are identical in either the liability they're trying to fund or the type of portfolio that they're trying to put together. Our goal at the foundation is several-fold, but we kind of see it as anything that's involved on the investment side. We are a fiduciary for our clients. We help develop the strategies. We help in picking the managers. We help in putting the asset allocations together. Where appropriate, we help in fee negotiations and things like that. So pretty much all encompassing whatever we need to do from the investment side, we help the foundation with. Kind of good timing for this, because as Matt mentioned, we are in an interesting time period for investing. It's kind of timely that we're having this today before the Fed meeting. The rates have been kind of crazy. Inflation's crazy. A lot of things are going on. Taylor's going to touch on some of that in a couple of minutes. But one of the most important things when you're putting together any program for investments, obviously, is asset allocation. You've probably all seen this slide before, but your mix between stocks and bonds is going to be the most important factor in determining what your returns are going to be long term. We do take a long-term approach to investing. We are trying to put together, diversified portfolios and not do market timing, although there is times when you can take advantage of the markets on a longer-term basis, and we try and do that. All the policies are all the asset allocation policies are set out in the investment policy, and Taylor's going to walk through the different pools, the investments we have, a little bit of the capital markets, and we can answer questions after that.
Sure. Sounds good. Thanks, Brian. So yeah, this is just a high-level overview of the foundation's investment strategy and how we work with them on a regular basis. So there was a bullet point on the last slide about the investment policy statement. That's the kind of the guiding principle document. It has a lot of important aspects in it. about roles and responsibilities, about, spending, certainly asset allocation, evaluating managers. There's a lot in there, and it's an important document, but we just highlighted a couple of key themes here, and Brian kind of hit on a few of these already, but, maintaining the long-term focus. I think when we did this last, it was around the first quarter of 2020. There was a lot of volatility. The world was shutting down. There were a lot of unknowns. We've had a lot of volatility throughout most of this year as well. The second quarter, as most of you know, has been challenging as well. But just the key is to maintain the steady approach, the strategic investment kind of long-term view, 5, 10, even beyond that, which is hard to do today. But that's really the goal, and that's what we work with the foundation with in the investment committee on a regular basis. So again, the focus is kind of a barbell approach. So we certainly want the assets and the corporates and the pools to grow, but also know that we need to preserve capital. So it's a balance between those two, which is done by not only the asset allocation, which as Brian highlighted is the most important, but also, investment managers. And historically, the foundation has really taken the approach to, if you're going to pay for active management, we want the managers to pretty much be benchmark agnostic, and which will lead to periods of over and underperformance. And we certainly understand that. And over the long term, certainly the goal is to, for all of them to outperform, which doesn't happen all the time, unfortunately. But again, that just kind of ties back into the longer term mindset. Again, if we're paying for active managers, we want these managers to make specific bets and not look like the index, and you don't want to pay for a closet index type strategy. So maybe just on the next page, again, I think everybody's, probably familiar with these at this point, but as we work with the foundation and the committee, and other clients that have similar programs, don't look too dissimilar to this. You have a good range of options. So on the left-hand side, the money market fund, certainly not only the most conservative, but also from a time horizon, the shortest time period. And as you move across to the right, aggressive is probably the wrong word, but you certainly, get more aggressive in these pools as you add equities, both domestic and international. So it's a nice blend of ranges there from a risk return perspective that we think give investors a lot of different choices. And then a couple of the characteristics below that we think are important. It's a good mix of passive and active. That's been a topic that will never go away. So we have a lot of passive in the domestic equity universe, especially in the large cap space, which is very efficient. But we also have active managers on the international equity side, on the fixed income side, where over time, those types of asset classes have been able to add quite a bit of value. I'll skip the second one there, but the bottom two bullet points, we don't have any alternatives in here. It's hard to do in a mutual fund format, frankly, and if there are alternatives in a mutual fund, they tend to be pretty expensive. So we don't have those, and also we use institutional share classes. So we're benefiting from managers that the foundation uses in other pools, so that we really get the lowest cost options really across the board with the active managers that we use. So we have a couple slides in here on the market. It's certainly been a challenging year, and some of this is a little bit dated, but some interesting slides that we thought we would share quickly. This one on page 9 just shows what the annual returns of global equities are. So that's on the left-hand side, the MSCI All Country World, and then fixed income returns, which is represented at the bottom, the Bloomberg Barclays Global Aggregate. So global equities and global fixed income. And you can see where we are, year to date, and this is still in this bottom left quadrant. But really the point here is that it's been an unusual year. Typically fixed income in a portfolio is kind of the core, the ballast, offers diversification when equities are negative, which happens most of the time. But unfortunately, with the rates going up across the curve throughout the year, has been a challenge for fixed income as well. And we'll hit that in a minute. There's really been nowhere to hide on the fixed income side. So I think one of the key points that the market has been focused on, and certainly the Fed is focused on in trying to fight.
Oh, did we lose Taylor? Taylor, I think you're muted.
Sorry about that. Can everyone hear
There
me?
you go. Yep, you're back.
All right. Is that better?
Yep, you sound good.
Sorry, I was on the phone hoping that would help and that cut off. So back to the computer. So certainly inflation has been a key focus for the market. As you know, I mentioned that the Fed is doing everything they can to fight it. We have seen some relief, at least on kind of the energy side and at the pump. But some of the areas that are, call it a little more sticky, particularly shelter has continued to rise. And will likely rise, as we kind of move throughout the rest of the year. Some other areas are volatile as well, like food and energy. It's impossible. I wish I had a crystal ball with this, but we don't think that inflation is going to get back to 2% anytime soon. Certainly, we would hope that it would trend downward as the supply chains continue to ease. Certainly, Russia, Ukraine has had a big impact on this. But we'll see what the Fed comes out with tomorrow. I think everybody's anticipating another rate hike, but just kind of the wording that they use going forward, it sounds like they are going to be pretty aggressive to fight this any way that they can. Domestic equity, really the point here is that been, again, on the fixed income side, no place to hide. The only area that has done well this year is energy. After a number of tough years, that's been the one area that's performed well this year, which has actually benefited some of the active managers that we have in the portfolio, particularly on the value side. The only other theme is just value in general. We've been in a growth-driven environment where tech and consumer discretionary and a lot of the high-flying growth stocks have really done well, except for this year. And you've seen a little bit of a reversal there. So if you look in the red box on the bottom right, the value parts of the market have held up better. This tends to be consumer staples, utilities, areas with, high dividends and what have you, which is what you would expect in a challenging environment for those areas to do well. And this just takes a look at something that we review at the committee, the premium of growth versus value. So this looks at the blue dotted line on the top is kind of, global equities that are growth oriented versus the gray, which is kind of the value benchmark. And there's been a very big dispersion. Certainly that has compressed quite a bit this year. And you can see that below. So we show the performance of the ARKK is one of the ARK kind of technology focused Catherine Woods ETFs. And we just show that versus, Berkshire Hathaway stock. Again, a very solid, value oriented name. And you can just kind of see the reversal that we've seen so far. So certainly a ways to go on the growth side. But, this is kind of what you would expect in the environment that we're in, especially with rates on the rise. Non-US, really, I think it boils down to the same story. Energy, again, has been the one leader. The makeup of the benchmarks outside the US are very different versus what we have with the S&P 500, but it's been a similar story, again, with value areas, really leading. So that's, whether it's consumer staples or healthcare or utilities, again, have held up a little bit better versus some of the more growthy areas, technology, consumer discretionary, and what have you. And then fixed income, again, we have active managers in the portfolio. And, I think a lot of active managers have had a shorter duration, which has, helped a little bit as rates have risen. But if you look down at the bar chart below, again, even, high quality government bonds are negative, especially longer duration bonds are down, over 20% this year. So again, in a tough environment, there's been no place to hide on the fixed income side. And meanwhile, if you just look at the next page, if you look at some of the spread sectors, so this looks at kind of investment grade corporate bonds in the top, and higher yield or high yield bonds in the bottom. Again, kind of riskier corporate debt. We haven't really seen spreads blow out that much versus treasuries. They're kind of back to their longer term average. So on the fixed income side, a lot of it has really been about duration this year with rates going up. So haven't seen a lot of new opportunities on the fixed income side. And again, the managers that we have in the pools are very core like managers. So they're pretty conservative. Again, we kind of view that as a ballast in the portfolio.
Yeah, Taylor, before you jump into this page, just a quick comment, kind of mentioned that this is slightly dated. This isn't quite as dated as the information we gave before, but July, we saw the rates move in the opposite direction, right? They went down quite a bit after a move up for most of the year, but we saw that reverse in August. So a lot of the gains that you're going to see in the July time period, especially on the fixed income side, have been wiped out in August, and probably will continue to go up as the Fed continues to increase rates on the short end. Go ahead, Kelly.
Yeah, no, that's a great point. But I think everybody knows, that the key takeaways here, again, on the domestic equity side, a low cost index option that is also Catholic screened. On the international side, we're balanced between Dodge and Cox. I'm sure a name, some of you are familiar with, which is a value manager, and then Harding Loevner, which is more of a growth manager. So again, not trying to call growth versus value, having a balance in there. We think those two complement each other. And then on the fixed income side, again, Dodge and Cox and Baird, again, very core managers, not taking a lot of risks, not making a lot of, duration bets and going into a lot of low quality or emerging markets or other areas of fixed income. Again, just, more of a conservative posture on the fixed income side. So we have more information on each of these managers on the next couple pages. Won't really hit any of those unless there are any questions, but this is something that we share with the committee on a regular basis as we review the pools and the managers. So I know there's a lot of information on there as well, but again, I think we're pretty happy with how most of the managers have done this year in a tough environment, and especially over the long term. We think that they've done pretty well as a group overall.
Yeah, I guess the only other comment to make on this page is, if you sat in on this discussion in 2020, I think the only name that's different from then would be Baird. We had Western Asset in the portfolio. They had struggled a little bit. We kept them in the portfolio as we expected returns to improve there, with the thought that once they did, we would move them out of the portfolio and put a less aggressive manager in, which we did, and Baird has held up a lot better than a Western has in an extremely volatile fixed income year like we've had this year. Western's down double digits, 11, 12% through the end of July.
That's a great point. So maybe just, the last two slides here, quickly, and then happy to, answer any questions or take it in any direction. But, again, this is just a slide that, you see in a lot of different ways, and it really just tries to show the long-term return of the S&P 500 from June of 1972 through June of this year, and what the actual return has been. And then, the different color bar charts is if you're out of the market without the top 10 days, the top 20, and so on and so forth. So again, it gets back to market timing. As Brian mentioned, we try to do some rebalancing and, hire managers here and there when you can. But we're not market timers by any means. We would get this wrong probably every time if we tried to do it. So, it just goes back to maintaining the discipline, taking a longer term approach. And those are just kind of some of the key, I guess, final remarks on page 23. And these really haven't changed since the first quarter of 2020. Again, just remaining patient. Ensuring that, cash needs are met. Again, it varies by institution. We kind of say usually 6 to 12 months, as well. Some groups are comfortable having less, some want a little bit more. So again, a customized approach depending on each group, and just the rebalancing, again, trying to get back to targets, when we can after there's a sell-off, and just, make sure we're not drifting too far from the overall asset allocation in volatile periods like this.
Yeah, and last comment on the current market and what's happened this year. I mean, it has been really volatile in fixed income. Returns have been negative. We are at a period now, though, where rates have come up enough to the point where the yield that you're getting off of your fixed income offsets a bit of the duration move. So you probably won't see as significant of moves in fixed income returns, meaning significantly negative from this point moving forward, although they still could be. It would just take much bigger moves to get there. So that's beneficial from the standpoint of a tough month like we're having now. At least fixed income is going to offset things a little bit from this point going forward.
Well, Taylor and Brian, thank you for all that information. I will tell you that I'm finishing up about 10 years here at the foundation. And the one thing that's very comforting is having a solid investment policy statement that is reviewed on an annual basis and being able to follow that as your roadmap. I know that I hear when in 2008 and 2009, the foundation had a steady hand on the investment side. Nobody was reacting, quickly trying to rebalance at the bottom or whatever. Let's get out of this market and so forth, and recovered very quickly. We experienced that through a couple of the dips since in the last 10 years. The prime one was in 2020. A group of us, some of them on this call, were in the Holy Land when the market tanked with all the stuff coming out with regards to COVID and so forth. And the reality was we weren't going to take a different perspective because we were looking long term. So I think not trying to time the market, but focusing on your investment policy statement is the best thing that you can do. So any questions from anybody on the panel here today?
I have my hand up, Matt.
Oh, Frank, please go ahead.
So in your asset allocation, what are the asset classes that you're using that have low correlations with the equities primarily to allow you to achieve your risk targets that you have? I didn't see very many asset classes in there, so could you help me understand what you've got?
Sure. So we can either do the managers or maybe the chart that has the different pools on it. So, again, I think it's a balance of, not being too simplistic versus being over diversified. So really what we have in here are the 5 active the 4 active managers, and then the one kind of passive Catholic screened index. So on the domestic equity side, when there's an allocation there, we have the Christian Brothers screened index. So it seeks to track the S&P 500 with the Catholic screens overlaid. We have the 2 international managers, Dodge and Cox and Harding Loevner, and then the 2 fixed income managers that we discussed a little bit, Baird and Dodge and Cox on that side. So again, fixed income and cash are really there to offset and add diversification versus the equity managers that we have on the long only side.
Yeah, and Frank, part of it is, and good to see you, by the way, I haven't seen you in a while. The managers, like the change we made with WAMCO, one of the reasons we made that was because the way they were invested, they were starting to correlate a lot more with the equity side of the market than you would hope and expect. But from an asset allocation standpoint, from an asset class standpoint, using the mutual funds and having, like Taylor said, somewhere in the middle of a simplistic to a super eclectic portfolio, we don't have a lot of asset classes that are super low correlated, right? It just isn't the way that we put these together.
What is the risk targets that you're using in your calculations? Risk of ranges of plus and minus. What do you all use as just your targets?
So we don't have specific standard deviation targets for these as they kind of move around. We kind of focus on the overall asset allocation, so the mix between equities, fixed income, and cash, and also the time horizon, as well. That's a key component of matching up with the pool and the time horizon for the investors as well. So there's no hard and fast targets that we have on that side. It's something that we monitor, but it's hard to kind of target those specifically.
Thank you.
A quick question, if I could. Clearly, the lack of alternative investments is an outlier compared to most management firms, even if it was 10 to 20%. Was the decision made at some point not to look at these alternatives?
I'll jump in on that one because we just discussed in their last meeting, John. We weren't going to offer the alternatives just because of the timing of the investments. So if you look at it, and we were talking only with endowments with people who were alive that would still be looking at it. What if they wanted to change their investment allocation and the timing? It might be years before that's paid out. So instead of locking somebody into something like that with the alternatives, we just said that would probably be better not to handle that. These are our pool options for people with I mean, above $1 million, you can have your own pool yourself. I mean, as a donor, but below that, that's where the pool comes into play with these different options.
Right. One other one, and I'm sort of a contrarian. Your market timing slide, I see those all the time. I would love somebody to do a market timing slide without the 10 worst days. It would be really interesting to see I've never seen that from anyone. It would be a really interesting comparison, and I would bet that it wouldn't be much different than the slide you just showed on the reverse side. It would have a positive impact versus the typical, but I've never seen it, so I can't.
I think you're right. I think it would actually show the inverse, but the same issue would occur, and that is, can you really pick them or not, right? I mean, but you're right. It would exactly show the flip.
Thanks.
Any other questions?
If I can,
Frank, you're muted, Frank.
my question has to do with your calculations for the amount of distributable charitable grants that you can provide. So when you're doing that, I forget what it is that you do is it a running calculation or is it done annually? And my real question is, for 2023, have you projected any impacts yet as a result of the challenges we've gotten this time period this year?
So fortunately, we use the spending policy that takes into account the 20 trailing quarters, the average of the 20 trailing quarters, to smooth out these types of valleys and the peaks of the last couple of years that we've done. Because, we were up at 13, 14% the last couple of years. And, the board could have said, hey, we have extra money, let's give it away. But the reality is we've stayed the course with the spending policy. And the board reviews each year with the help of advice from LCG on what other people are doing to set that spending policy. And right now it's at 4.5% of the trailing 20 quarters.
Thank you.
Any other questions? Well, if not, I appreciate all of you joining us today, and a special thanks to Taylor and to Brian for joining us. We will make sure that this presentation is available for you, so you can, if you need to spend some more time on it. I know it was a lot of information in a short period of time. And if you have questions, I'm sure that we can relay them to LCG and they'll get back to us to help out. So thank you again for all your support to the foundation. We appreciate you being donors, your help as trustees, and for those of you that have parishes that rely on us or schools that rely on us, we appreciate your support there too. So you guys all have a great day. Good seeing you all.